It's Friday, Wealth Works Friday. Joe is on his way to the beach for a lovely week's vacation. So he said, just do whatever you want. So I am doing whatever I want. And I think it was fun. And I kind of feel like we can have a little fun. So I found these questions on finance and investments. So what I'm going to do, and then of course we have our guru Jeff Allen in the house, so therefore we'll see what he answers and see how much he knows as well. But so what I'm going to do is I'm going to put up a question. You guys can interactively answer, and then I'll reveal the answer, and then we will kind of talk about it a little bit, because I'll tell you, I took the test and I didn't do very well, by the way. There's a disclosure right there. But I feel like it's going to be fun to see what everybody thinks and what everybody sees.
Well, I'm glad you didn't do well, so I won't feel bad.
That's what I'm saying. I was surprised by some of the answers, to be honest with you. I sometimes feel like, I don't know. So let me get the first poll going. I know that there's a couple people that are still waiting. You guys ready? How much did the average investor earn between 1988 and 2008? I can't believe I can't do my poll.
We can Google it real quick, right?
No Googling.
I'm kidding.
Hold on a second.
Is this a percentage?
I'm gonna do the poll right now.
Is it multiple choice?
Hold on a second. The problem is that Joe called in and I'm on his Zoom, so he blocked my Zoom. It's a Friday, folks. Always happens. All right, are we ready? Well, how much did the average investor earn between 1988 and 2000? And was it 5%, 2%, 3%, or 1.9%?
1.9.
5.
5. I'm going 5.
3.
Are you guys ready for the answer? The answer is 1.9. And it's interesting because look at, yeah, and it's amazing, right? Because look at the answer. While the S&P 500 index earned an average annual return of 8.4%, during 1988 and 2008, $1 would have become 5. The average individual investor earned an annual return of just 1.9. Jeff, does that even make sense to you?
Yes, because the average investor usually gets out at the bottom when they're scared, and then they usually all get all excited when the market's at the top, and then they get back in. So they're usually doing the opposite of what they should be. So between that and then, the average investors in a mutual fund with the fees involved, it would knock it down a little bit more. So, but most of it is probably because of getting out of the market at the wrong time and back into the market at the wrong time.
I agree 100%. I mean, the answer surprised me, honestly. Gosh, but what are you going to do? Any questions or any comments about this?
Well, considering my guess on paper was $150,000, I'm not doing well.
Exactly. Let me see if I can get this poll going again. Hold on. See? I cannot. Hold on one second, you guys. I got my daughter here talking to me. No.
She should keep score.
I know. Ali, you're going to keep score. I'm going to try one more time. I spent all this time putting this really cool poll, and then it didn't work. No, it doesn't.
You know what? Next time you want to do this, we'll do it at the studio, Yvonne, and I'll set up a green screen, and we'll have it all behind
Listen,
you in
wouldn't
3
that be
dimensions.
awesome? I want to do that.
That'd be fun.
I would totally want to do that. Hold on a second, okay? I don't know. Okay, let's go to the next question. Are you guys ready? If you delayed saving and investing until you're 40 rather than 30, how much less money will you have when you're 65?
Is this going to be a percentage number or a financial, like a money
This
number?
is going to be
What are our options?
we're looking for a percentage number. So this has to do with the cost of waiting, right? You start investing at 40 instead of 30.
Mm-hmm.
When you get to 65, how much less will you have? What percentage less because you waited those 10 years?
I'd say 50%.
I'm with Jeff.
I agree.
Ditto.
What's the rate of return? It's going to vary on that.
Well, that is true, but you know, the rate of return is irrelevant versus the number of years that you're doing it. Because there'll be ups and downs, right? It's about having time, more time for market variations. So the answer is 15%.
Oh,
So look at the example that they gave. So assuming an annual rate of return, there it is, 7%, Mike, right? If you invest $10,000 per year from age 30 to 40, you would have 890 44 to 65. But if you do it at 40, you would have 690 564. So that's 15% less waiting those 10 years. I kind of found this number to be kind of low. I thought also that it would have been a much higher percentage that you.
Yeah,
you know
that's
what I
not
mean?
that bad. I'm going to wait until I'm 40.
Right? What do you think, Jeff?
I think $10,000 a year between your age 30 and 40. If you're single, you could have a lot of fun on that $10,000 a year.
That's what I'm saying.
I mean, I'm not living till I'm 65 anyway, so that doesn't matter for me.
Right, exactly.
I mean, that number doesn't make a whole lot of sense because that's $100,000 invested over that 10-year period of time. But yet the difference is only about $120,000 between the end number. So that 7% annual, I don't know, those numbers don't really add up, but.
Well, and this is interesting, right? Because the source where I got this was one of the SEC kind of websites that they have in their system. So, I mean, it's a reliable source, but the problem for me is that I kind of feel, and I by the end of this presentation, maybe you guys will feel the same way. Anyone can make the math look whatever number they want to, right? It's kind of like you see all these statistics, you see all these numbers, but really at the end of the day, if you really look closely, you can interpret this a million different ways and make it whatever number you want to make it, right? I mean, there's no, inflation was not taken into consideration. I mean, there's a bunch of stuff that we could argue about this number. Look at the next question. During what years and periods the bonds perform better than stocks? And I'm going to give you a couple of options.
Okay.
love
Please.
options.
Yeah. Was it from 2000 to 2015? Was it 1968 to 2009? Was it 1950 to 1975? Or was it 1980 to 1995?
Go with A.
1980 to
Say-
1995.
Huh?
Correct.
Yeah, I was
Well, I'm not
even on
correct,
that
but
one.
I
80
would
to
say that
95.
from 80 to 95.
You guys ready for the answer?
Hmm? Oh,
From 1968 to 2009.
wow.
And it's interesting because and when you read this, oh, sorry, hold on a second. Let me go back. When you read this, $1 invested in bonds was a better investment than in stocks. What do you think, Jeff? Is that a fair
I mean,
statement?
I pick. I mean, it possibly could be. I mean, I would have guessed 1980 to 1995 because interest rates when Ronald Reagan took office were you had treasuries close to 20%, and then by 1995 they were probably, I'm guessing, down. They're most definitely in the single digits. And when interest rates go up, bond prices. Excuse me. When interest rates go down, bond prices go up. That's why I guessed that, because there was such a huge drop in interest rates during that time.
By the way, I
From
looked this up.
68 to 2009. That's a long period of time.
So that's exact. And so when I went and researched this particular statement, because I did every single one of the questions, I went in and made sure what the heck they were talking about. In fact, it is true. And the reason why in one of the articles that I read was because what was the interest rate in the 70s and the 80s?
Yeah, it was double digits. I mean, you had CDs like 17, 18% in the early 80s. And you also got to look at that ending period of 2009, right after the market got through taking a 50% drop right at that period of time in the stock market.
Yeah.
So, it's taken probably the worst period, the worst ending date for stocks that you could have ever picked.
Yeah, exactly. Well, because after 2009, 2010, this was not the case. Stocks did better than the bonds is what they're saying.
Well, 1980 through 1995 is included in those years. So I think we were at least partially right.
Yeah.
Yeah.
Well,
Oh,
you needed to be
100%.
100% right. Exactly.
I just assumed that. Did I have to announce that?
No. All right, here's the next one. Ready? Since 1890, what has been the real return on housing prices? Is it 4%? Is it 3%? 1% or 0%?
0.
2.
3.
Anyone else?
3.
3.
You guys ready? It's 0%. Who said 0? You're a winner.
I did because I saw the next screen.
You saw it before, didn't you, Anthony?
I did.
Housing price increases since 1890 have been close to 0%, factoring in the effects of inflation. Housing prices adjusted for inflation were also flat between 1945 and 2000. This absolutely, it was unbelievable to me, honestly. But in fact, that is the case. I saw the mathematics how they came to this, conclusion.
Well, not to mention the interest you pay on a mortgage
Right.
over 30 years. You pay double your price of your home usually.
So although real estate is an important component, right, of your overall portfolio, 100% of it in real estate clearly makes 0 sense.
I see what you did there.
What?
The play on words.
That's right. Any questions or any comments about this? Anyone else surprised by this number?
I'm totally surprised. This is Joanna.
Hi.
Where did you, what was the source for this so I can look it up?
Yeah, I'll send you guys the link after the meeting. It's got, and by the way, I only pulled out 10. It had the first ones that I saw had 24 questions. Some of them a little bit more convoluted and a little bit more technical than others. I just pulled out kind of the 10 that I found kind of interesting. But this, I will send out the link because I think it's important to look at some of this stuff and really question, gosh, right? I mean, if a client is talking to me about, wanting to be 100% in real estate, I might want to talk about this. So yeah, I'll send the source out, Joanna.
Thank you.
Anyone else had any comments about this or maybe challenge this? I am by no way professing that that's, the accuracy of the information is here, but whether we agree with it, again, anyone can make whatever number, right? Look good. All right, next question. So between 1983 and 2003, the US stock market return was 13%. What was the average investor return?
Five.
What? Okay.
It's a wild guess.
4.
You
Is
guys could-
negative an option?
No, negative is not an option. It was a positive number.
2.7.
1%.
Oh, I'm sorry. Here comes my dog. Can you grab her?
I
My
speak
dog thinks that
dog.
she's a little multi-poo this big that weighs 5 pounds.
Huh.
She's no threat.
She
All right,
doesn't
here comes
think
the
so.
answer. Are you guys, oh, can you want to show her on the screen here? She's just gonna bring her here. Here, go say hello to the group. Here she is. This is
That's a
Cujo.
squirrel.
Yeah, she looks like a squirrel. Anyway, so here's the answer. Are you guys ready?
Yeah.
Yep.
Oops.
Wow.
So the U.S. stock market return was 13, but the average investor had a 7.9, which is 5.1 less. The average equity fund return was 10.3. This highlights why you need a good financial advisor. That's exactly what he said on the source that I got this from. What do you want to say about that, Jeff?
You're a financial advisor.
Well, if that part, of course.
I mean, this is always, what's talked about, and it also gets to passive investing versus active investing. With the, most mutual funds underperform the market, even though they own just about every single stock in the stock market, they still underperform. And I think part of that is because of over diversification, but that's just a personal opinion. And then the 7.9 by the individual investor, I think, goes right back to the first question, where the average investor usually gets out at the worst time and back into the market at the worst time.
Right.
They're letting their emotions make their decisions versus data.
Exactly. Anyone else surprised by this number?
I think it's also a great opportunity to talk about the difference between average and actual returns.
Yes. Excellent, Joanna. That's exactly what this is, right? But here's the thing. Normally, with a good financial advisor and someone that, educates themselves, you can probably turn that 7.9 into a much better return, right? If the market was returning 13. But the problem is the inability, I don't know if maybe the unwillingness, I don't know which one would it be, for kind of people to educate themselves and understand really what, they meet with their financial advisors, they do things, but they don't really take ownership of this. And then one day they see numbers that they think should be better than, right, Jeff? And so education, as far as I'm concerned, and working with professionals that know what they're doing. Any questions or any other comments? All right, let's go to the next one. Okay, so how much, and this will be, by the way, a dollar number. So how much do you need saved today to reach $1 million if inflation grows at 3% per year? So to age 65. So if you wanted to have, right, $1 million, what would that $1 million be worth at 65 with a 3% inflation? And I'll give you some options, okay? Option number 1, 620,000. Option number 2, 412,000. Option number 3, 550. Option number 4, 680.
How old is the person now?
Yeah.
And how many more years do we have to get to age 65?
Let's not worry about that. Let's just say 30 years, regardless of age, right? So 30 years. So that makes him, let's just say 35.
Okay.
The question does say, I should have put the year there. You're right.
Was it 500 was one of the option?
Yes.
500.
Okay. Any others?
680.
680.
Okay. Oh, here we go. Let me go over here again. It's 412.
Wow.
So with
That
3%
was my
inflation,
choice silently.
what's that?
That was my choice silently.
Well, you can't silently choose, Steve Lobella. You have to. If you don't say it, it doesn't count. No, but this is interesting, right? With 3% inflation, $1 million in 30 years will be the same as $412,000 today. So for those who say, well, I'll have $1 million when I retire, that means really what? You're going to be living below your living standards, right? If you want to retire with $1 million today. So here's an argument as to why it's important to get in and it's important to save consistently. And, you know, any comments about this, Jeff?
I think people, I mean, it just, you know, hammers the fact that you got to have a lot more money saved for retirement than most people think. I mean, used to, if you had $1 million, man, you thought, you know, retire $1 million, you'd be able to live like a king, and that's, you know, not really
Not really, right,
the case anymore.
right.
And especially if you want to leave anything to your heirs.
And you know what, and let's talk about inflation. The next question deals with inflation. And let's go to that one. What was the average inflation rate between 1967 and 1984? Think of the years.
4.2.
Okay.
5.
I know it was high.
Who said that? Who knows?
The average
was
over time, I think,
stagflation.
is like,
Well, after 71 with Nixon and the gold standard, it wouldn't surprise me if it was 30% in those years.
5%.
Exactly right.
I'm gonna go 21, 22.
Oh, that's high. Okay.
Wow.
You guys ready for the answer?
I retract.
The answer is 7%. So from 1967, the average inflation rate was close to 7% when taking all the years, versus close to 30% average for the past 100.
Hmm.
So you see the difference? Excuse me, 3%. So you see the difference there?
I thought it was cumulative over all the years.
Well, just between this period, 1967 to 1984, it was 7%. But overall, over a 100-year period,
the average.
the average is 3%. Questions or comments about that?
When my father was a real estate broker back during this time, and he died shortly after 1984, but that was the current rate of housing prices increase was 7% during
Really?
that time frame. Yeah, that's what you could expect. Well, at least in California.
Right. Interesting. All right, next question. What was the top marginal U.S. tax rate in the 1950s and 60s? And I will give you some options. 50%, 65%, 20%, or 93%.
93.
93.
You all already know. Right? Yeah, and it's interesting, right? The top was at 93 in the 1950s and 60s. It was 70% in the 1970s, 50% in the early 1980s, and 35% from 2003 to 2009.
Wasn't it the top rate kicked into the $100,000 at that point? And that's why Ronald Reagan, when he made a movie, he didn't make $100,000 per movie. He made $99,999.
I remember about that now that you're saying
Exactly.
that. Yeah, exactly.
And he only made one movie a year.
Yeah,
Yep.
exactly. Hey, you got to do what you got to do, right?
Uh-huh.
So no, this number surprised me for sure. I guess I didn't realize, right? I guess marginal tax rate was never something that I really paid attention to, but I kind of feel like I need to start paying attention to after seeing these numbers. So, any other comments or questions about this? Okay, next question. So going back to savings, right? What was the U.S. savings rate from 1960 to 1980? And I'll give you some options. Hold on. Was it between 15 and 18, between 8 and 12, 6 and 8, 5, 7.
8 and 12.
6 and 8.
6 and 8.
8 to 12 was the top rate, right?
12.
What was the U.S. savings rate from 1960 to 1980?
Yeah,
Yeah.
your top range, 8 to 12.
Yeah. And that's right. And it's interesting. Here's what I found really interesting, right? Between those years, 8% and 12% from 1960 to 1980. But then look at this. It was below 2% in 2007. What happened? Why did people, you guys think, stop
I
saving?
think a lot of the generation that was included in there that were in their prime peak earning years were people that kind of grown up or were kids in the Great Depression and saw how important it was to save. And, you know, and then in the later years, like we are now, we're much more of a consumer society than we were from 1960 to 1980.
Yeah, I mean, I kind of agree with that. What is the current U.S. saving rate? So, you know, Jeff? I should have Googled that.
I would guess it's right there close to the 2007 mark. I don't think it's changed much. I mean, it may have just in the last couple of months because people aren't out spending as much money as they were. So, you know, they may be pocketing a little bit more in the last couple of months. But I would say we're probably right around there from 2007 would be my guess, but I don't know the answer.
Yeah, I mean, for me, the first thought that came to my mind was, right, I mean, let's talk about technology. Technology between 1960 and 1980. I don't know, it seems to me that as technology grew, I don't even know if this makes any sense actually, but to me, there's a disconnect going from saving, and I don't know about you, Jeff, but I know how difficult it is for you even to say, hey, you should be saving 10% of your money, right? And people are like, oh God, I can't afford that. So, you know, I don't know if maybe the stock market, I don't know how to answer this number, but it concerns me and this should be talked about with every client because saving 2% will get you nowhere.
Mm-hmm.
Any other thoughts on this? What do you think, Mike Stevens?
No.
Or Steve Labella?
I think that you told me that this exercise today is supposed to be fun. I've got only one answer correct. I'm not having any fun.
Listen, that's on you, man. I am so sorry.
You know, I think that
during-
savings.
Go ahead, Jeff.
No, I'm sorry. I was going to bring up another point. Please finish. I interrupted. I thought you were finished.
That's all right. I think during 60 to 80, we were more focused on savings. By the time that we hit 2007, we were at instant gratification. So when we see something, we just took it off the shelf and didn't save.
Yeah.
Yvonne,
Yes.
when you're saying 2% savings, is that just people putting money into like a savings account, or does that include like, you know, 401ks or?
Yeah, this includes it all, Jonathan. The source,
Wow.
when I read the source, that's what also surprised me. That's a good question.
Yeah.
Because it includes all the qualified plans. So, you know, it's really amazing.
It's the microwave generation.
That's right. That's right. And it's kind of sad to me in a way that you don't need to sell the first thing you need to sell a client is the importance of this. And this is something that shouldn't be sold. This should be something that automatically people should want to do, right? And as a matter of fact, I was with a client not too long ago who his words were these, right? Well, it doesn't matter because I can die. And then, you know, that money would be just left for other people. And I kind of feel like there's a lot of people that feel that way. And it just blows my mind.
And I think that low number, just like I'm sure it is today, is why the government felt it was so important to hurry up and get those $1,200 checks out to everybody to save the economy, because people did not have the money saved up just to make, you know, the next month's mortgage or rent payment because they hadn't saved anything for a rainy day.
Yeah, exactly. Any other comments or thoughts about this, you guys?
Yvonne, can you hear me?
Yes.
Okay, so I just Googled, statistics.com, and it says that from February 20th to, at February 2020 of this year, our savings rate went from somewhere near 13% up to 33%.
That's an interesting number. But it makes sense
It does.
because people were not spending. Interesting. All right, let's go to the next question. It could very well be the last. I think it's the last one too. I don't want Mike Stevens to get any more frustrated with my questions.
I got a chance to get 2 right here, so.
Let's go. Yeah. What was the median household income in 2007? And I wonder why they kept using the year 2007, because they're kind of broke down the numbers between prior to 2008 and after 2008.
So is it multiple guess? Do we get some choices?
I'm going to give you some choices right now. Is it 100,000, 75,000, 60,000, or 50,000?
75. 75 or 50.
Median.
60.
60.
Okay. Are you guys
65.
ready?
Mm-hmm.
Oh,
Isn't that interesting? Doesn't that seem like an awfully low number? And then to say that the top 10% had income above 140? What do you guys think?
I think it's right.
What do you think, Jeff?
That I'm not surprised by it. I mean,
Really?
it's no.
I honestly thought that would be a much higher number. Just because that was, 2007 was when the, real estate market was booming and, right? All those things were happening.
Yeah, but again, that's, the top 10% that were, that were benefiting from that. I mean, there's so many households out there that, that are in that lower middle
Yeah.
areas where the largest percentage of the population is, I would guess.
Yeah, that's true too. Any other thoughts or comments about this statistic? And I will send you guys all, I think this is the last one. Let me just see. I want to go back one. So one thing that I kind of took away from this, as far as I'm concerned, is that the best investment that you can do is really educate yourself, right? And I like this quote from Benjamin Franklin that says, an investment in knowledge pays the best interest. And I kind of feel like the next time that I get a client that says to me, right, what kind of interest, what kind of rate of return am I going to get? My answer is going to be, well, you're going to get as good as you're going to educate yourself with, right? I mean, I feel like, we ask our clients to go through an education process with the Nash book and with all of those things, but are we really holding them accountable? I feel sometimes I give someone a book and I continue my process on whether or not they've read the book or not read the book, kind of violating, right? The reason why I gave the book. So I started last week kind of saying, I can't meet again until you read at least the first 40 pages of the book. Because I find myself trying to educate people from the very beginning without them taking any interest in it themselves. Is that a fair statement? Do you guys feel the same?
Mm-hmm.
Anyone else has that same problem?
Are you talking about clients, by the way?
Yes. I'm talking about clients, but I'm also talking about advisors, right? As advisors, we need to keep ourselves current. We need to keep ourselves educated so that we can know exactly what kind of education, and it's our responsibility to, you guys participate in things like this, in other podcasts, to always try to continue to grow, not just from a product standpoint, but from what's going on, period. Whether you sell investments or you don't sell investments, to be aware of what's going on in the market, you know. And when it comes to passing that knowledge down to a client, I have found myself trying to teach unteachable people and having a hard time cutting that relationship early and investing way too much time for not any results. That's what I'm trying to say. Is that it's trying to get the clients to understand that the first investment they got to make, right? It's their own knowledge, what they need to learn from what their goals and dreams are. And I don't know about you guys, but I have found so many times that, you know, some of my clients' goals are so unrealistic based on the reality of the situation that, you know, there's just a disconnect between what they believe to be and the reality of the money. Does that make any sense?
Absolutely.
Right.
I think that when we run into clients that want to start their banking system or want to take out some sort of insurance policy, that they really don't have the overriding desire. It's, you know, oh, well, it's January 1st, so I'm going to set out to lose 20 pounds this year or lose some weight. And then January 2nd hits and they're, you know, digging into a half gallon of ice cream.
Mm-hmm.
I think that's the, you know, it sounds great. It's enticing to get someone to have them think about moving forward, but can they do it? You know,
Right.
I need to save more money, but will they do it? Will they not touch it over the next year and keep it hidden away? So that desire that Nash talks about in there, you have to have the desire to get out of debt, to protect your family, to whatever it happens to be. I think that's the controlling factor that needs to be instilled in the clients.
For sure. No, I agree 100%. And I think that, you know, I mean, at the end of the day, you know, we're here to educate people, right? But we need to educate people who are teachable, that want to be educated. I don't want to have to convince someone that their future is important if they don't believe that it's important to, you know, to themselves. And I have found myself trying to change someone's mind about how to prepare, and it's useless. You just have to work and with people that want to learn about what it is that we do, and, you know, and continue the education moving forward. Before I forget, I want to introduce, is Mike still, there's Anthony Tate. Is he still on? Anthony,
Yeah.
are you on? Okay. So Anthony is our newest associate. He is, hello. He is now starting an independent broker contract. So Anthony, I just wanted to give you just a second to kind of introduce yourself and tell them a little bit about you. Put you on the spot.
Well, hello. My name is Anthony, and I'm new to the firm. So she said all that. Father, married, kid, love it all, and willing to learn. This infinite banking concept is really cool. So I'm just reading the book, 2 books that he gave me, and yeah, that's just pretty much about it. I'm from Hawaii. I'm in Vegas right now. I've been here for about 4 years, and I have a fantastic life, getting better. So,
well, welcome. No, we're excited to have you, and, you know, we'll introduce you one-on-one with each of our associates so that, you know, you can pick their brains as to what, you know, their systems and processes are. So welcome to the firm.
Thanks. Looking forward to it.
Thank you. Okay. Anyone else has anything else? Because my little polling didn't work the way it should have. And this was Jonathan's fault. Jonathan, I saw you do the polling on one of your Zooms, and I tried it, but then Joe kicked me out. So it didn't work.
Yeah, it's a cool feature.
It is super cool, and I was super ready too. And then he calls in and he knocks out my ability to poll. So I will redo it, and next time it's going to be on a really cool poll. You'll see. Any thoughts, any comments I'm gonna for the advisors on the call, I will say this, right? I mean, we just went through a crazy time where the world's reopening, people are going back to work, but in our business, right, the summer tends to be quite slow without the pandemic, right? That's just our business is cyclical. Normally during the summer, really, more clients are on vacation for whatever reason, things slow down a little bit. So if you were not active during the pandemic, getting your inventory, if you were not doing the things that you had to do, the summer is going to be, don't let the summer get you in an even deeper, because once August, September comes in, and normally the third, fourth quarter are the highest quarter for us. If your inventory is dried up, it's going to be a very difficult end of the year, right? So please continue. I know it's difficult. Please continue to be out there. I know a lot of people are going to go on vacation. However, Joe and I are always available to kind of help you talk to the clients. And interestingly enough, by the way, I kind of feel like Joe and I have been busier this last month and a half than we were the first whole quarter of the year. So I feel like clients really, really are thirsty for information and thirsty for new ideas, because they're frustrated and they're tired of whatever current situation is happening. So don't be afraid to, talk to as many people as you can about what we do, and, continue to forge forward. Anyone else has any other words of wisdom? Valerie, why haven't you said anything, girl?
Because I'm here with my kids, teaching them schoolwork and making breakfast and doing all these things. It's very loud. Sorry.
Mama, your kids still in school?
Yes.
Okay.
It's been great, really interesting.
When is it over?
That next week.
Okay.
Next week.
Oh my God.
Yes.
So you're gonna have a party, one party all by yourself.
For sure.
Exactly. All right. Well, it's 10:45. We're a little bit early, and that's okay because it is the weekend. If anyone else has anything else they want to share. If not, have a wonderful weekend. I hope that you guys had fun with did you guys enjoy this whole
yeah, very cool. Thank you.
I just wanted to do something a little bit more different than just sit here, just have a little fun once in a while. Geez, doesn't have to be so serious all the time, right? All right, you guys have a great weekend. If you guys need anything, let me know. We'll see you next Friday.
Thanks, Yvonne.
Bye.
Thank you.
That was cool.
Thank you, honey.